all that's done is show how even the debt problem is even more intractable than you may have guessed. So perversely, in an attempt to try to rein it in, all they did was illuminate how entrenched the problem was. So that's a negative for the bond market. That the bigger problem is that if we have some weakness in the economy or the market, the Fed hands may get tied as to how they can respond. Now, if we had a series of really bad economic numbers or the market crashed for any group of reasons, the Fed would come in and ease. And if they didn't get away with it, then that would be the start of it.
Hello, and welcome to WorthNet. I'm your host, Alex Daley. Today, we're joined by Bill Fleckenstein. He's been a professional money manager for more than 30 years as president of Fleckenstein Capital. He's also shared his daily market commentary since 1996 and has gained a reputation for calling bubbles. Bill has been a vocal detractor of Federal Reserve policy, even penning a book, Greenspan's Bubbles. Bill, welcome to the show.
Well, thanks for having me.
Bill, you've long been a proponent of the theory that the bond market would eventually take the purse strings away from the U.S. government for overspending and having too deep of a deficit. Lately, we've got Jamie Dimon, Druckenmiller, Warren Buffett even talking about wanting to stay out of long bonds. Is the bond market finally starting to send that signal to the U.S. government?
I said it would take the printing press away from the Fed. The Fed is the problem. The Fed pursuing irresponsible policies for, 30 years now. They have, in addition to precipitating two bubbles which burst and maybe one that's quasi underway in certain areas, their money printing and the fact that they purchased $8 trillion worth of debt or so has enabled the can kicking that has gone on by the legislature and the president of the last 30 years to build the debt. The debt is a problem, obviously, but the irresponsible policies of the Fed are what allowed us to get here. The Fed's the one that primarily is the big engine of inflation. Not to say inflation can't occur via other means and disruptions, but printing money obviously debases the money that's out there, even though they're not printing actual dollar bills. We're talking about an electronic species, but now that everyone's familiar with crypto coins, you can imagine if you increase the supply of any particular coin, the value of it would go down, all things being equal. So,
yeah, what do you think about Federal Reserve policy right now? I mean, you've been very critical of it over the last 30 years or so. You wrote a book called Greenspan's Bubbles, and that took us through this sort of zero interest rate policy, ZIRP as they call it. We're not there anymore, but we certainly haven't raised rates significantly. They're barely keeping up with inflation. What's your judge of the Federal Reserve right now? Are they painted in a corner? I mean, what do you expect them to do next?
When you consistently pursue poor policy or make poor policy choices, then your options the next time you have to make a big decision are going to be worse than if you'd made a good decision prior to that. And it gets cumulative. So some people think the Fed should cut because the economy's on the weakest side. All you got to do is look at the size of the deficit and say, I don't think there's any real demand for the Fed to cut rates right here. I mean, I think rates are fine where they are. And one of these days, we'll get to the point where the decision is not made by the Fed, but is made by the bond market. And I used to tell people this. I've told people this for a long time. And of course, when rates went to zero during the COVID fiasco, it seemed incomprehensible to people that the bond market could stop the central bank here or anywhere else. And yet rates have backed up since the last time the Fed's cuts. From the time they just started easing, the bond market has backed up, right? Normally, you would expect the bond market to rally. Litmus test would be if they cut at the next meeting and the bond market declined again, that'd be twice in a row, and it'd be hard to say it was just noise. So it'll be the bond market's job to eventually stop the Fed, and that may be in the process of being underway now. The fact that we have an out of control budget deficit and therefore out of control cumulative national debt makes the whole problem that much trickier and I guess in some ways more meaningful. One thing that the Doge has illuminated is just the level of absolute waste fraud and theft, really. It seems like, in how some of this money has gone out and things that have gone on. But the fact that there's not unity in Congress over this topic, it's like Congress doesn't seem to care that it's become obvious that there's all of the waste, fraud, and abuse. And it just kind of shows to me they're kind of all in on it. Perversely, or not, I don't mean every single one of them, but the vast majority, they don't want to do anything. And people are protesting what they did at USAID. It's like, how can the country be against reining in waste, and just complete, it's all nearly theft, it seems like. But if that's the attitude, then all that's done is show how even the debt problem is even more intractable than you may have guessed. So perversely, in an attempt to try to rein it in, all they did was illuminate how entrenched the problem was. So that's a negative for the bond market. The bigger problem is that if we have some weakness in the economy or the market, the Fed hands may get tied as to how they can respond. Now, if we had a series of really bad economic numbers or the market crashed for any group of reasons, the Fed would come in and ease. And if they didn't get away with it, then that would be the start of it. I mean, but these are processes. You got to remember, bond market, bull markets, and bear markets last 30, 40 years. So a couple of generations. I mean, that's just the history. So this bond bear market, which has been going on, let's call it since COVID ended a couple of years ago, is really in its infancy. And the surprises will be to the upside, as in higher rates.
Interesting. So you're suggesting we are at the beginning of a new bond bear market. Last one was a bull market, right? For the last 30 odd years, pre-COVID at least.
1981 and ended, pick a number, somewhere in 22, 3, 4. It doesn't really matter what the precise date was.
And the signposts you're looking for to indicate whether this is worsening is sort of if the Fed is painted into a corner.
Yeah, no, it's
weakening economy.
How the bond market responds to future Fed easings, right? And that'll be impacted by a whole bunch of variables: FX, the current view of the economy, politics, blah blah. But net, I think the bond market is skeptical of the Fed in terms of being able to prevent inflation.
That makes sense. And there's a lot of theories out there that maybe our global markets are too concentrated, supply chains are too brittle. You've talked quite a bit about that, the sort of systemic factors that would lead to inflation as well. Do you think that more inflation is likely over the next 2, 3, 5 years? Is this going to be a high inflation period we're heading into?
I think the mistakes will be net to precipitate more rather than less inflation. Yeah.
Yeah, it's going to be a tough period on consumers. How does that play out in the markets? We're seeing a softening GDP. It looks like maybe a softening labor market. The ADP report just last week was a little bit flat. Like if we do see this sort of weakness in the overall economy in the US, what do you see it likely that the Fed is forced to step in and ease sooner rather than later?
Well, I mean, weakness at the margin is economic weakness is kind of showing up at the margin. Exactly how weak is hard to say. I think a lot of people, I would have thought that things would be weaker now than they are. It's more kind of stagflationary to me. That's been my view for the last couple of years, with the surprise being we could have a move to the downside. The problem with that, when you look at it, is that the budget deficit being as big as it is, whether it's going to be 5% of GDP or 7 or 4, I mean, given the fact the economy is not tanked, it is a tailwind to the economy. There's a lot of, the employment data is lagging, and it's really poorly constructed because of the birth-death model, which always is wrong at the turns. And beneath the surface, there's a surprising level of difficulty of young people in, say, even computer science to get jobs right now. This is just anecdotal evidence that I've heard and read about. But if the economy was really as good as people seem to want it to be, you wouldn't think that, electrical engineers and computer science kids coming out of school would have a tough time getting jobs. Microsoft laid off 8,000 people. Now, that's partially because Microsoft and these other companies have spent so radically on AI and have not really seen any profit benefit from it. And they've got huge depreciation schedules coming. They're maybe trying to cut costs. But I think the economy is not as good as the macro data would suggest. It doesn't suggest that it's a super strong economy, but however strong it looks, it's weaker than that.
Do you think it's a possibility that the corporations are just cutting ahead of sort of, uncertainty and weakness that they see?
Companies don't tend to do that. Uh, Certainty may stall something, but uncertainty doesn't make you fire someone, right? Because you're not certain. Firing them's a big step, assuming there's somebody where it's a tough decision, right? If somebody was a bum, then that would have been an easy decision. You probably would have gotten rid of them already, right?
Yeah, absolutely. It's a very good point, right? Companies, they don't want to lose competitive market advantage. Nobody wants to be the first to cut and find themselves
Yeah,
losing
it's
market
you,
share.
you have
Computer
to get
science,
you have to
computer
be
science. Sorry, go
pretty
ahead, Bill.
confident. You have to be pretty confident that things are getting worse to start. That you could be wrong about that decision, but you'd have to have a fairly high degree of confidence that that was happening to want to start, laying off people,
Yeah,
generally speaking.
if layoffs are happening at Microsoft, at Google, at other places, like it sounds like maybe they are seeing that weakness ahead of us.
But then you got to be careful there because these companies have been the ones that have spent like drunken sailors on AI. And so that may be related to those dynamics and how they're worried about. So on the other hand, if the economy is strong, those people should easily be reabsorbed. And doesn't necessarily look like that's the case based on the anecdotes I was just sharing with you, which again is a very small sample set, but it could be informative.
Makes sense. So for investors who want to position themselves for the beginning of this bear market, right? If we're going to be in a bond bear market, if easing might be coming, if the economy weakens, how should investors change their portfolio allocation? What signposts should they be looking out for? Like how do you handle a portfolio through this kind of market?
Well, the whole dynamic is incredibly complex because, first of all, we have this towering debt that we've talked about. We have the bond market potentially on the verge of being the disciplinarian of the Fed, neither of which are friendly for asset prices generically, particularly financial assets. And then you've got the incredible headline risk every day of Trump making a decision, changing his mind, the other side making a decision, changing their mind. We have a media in this country that is essentially, all the entire mainstream media might as well be labeled Pravda because it's almost all propaganda. The first three things they care about are my agenda, my agenda, my agenda. The truth is like 105th on the list. And so it's very difficult to get everyone to be willing to address issues when there's divisiveness created and we can't even, think about the insanity of this. Elon Musk builds the businesses he builds and he creates this car and everyone wants to be green and show their, the virtue signaling. I'm keen on the environment and and then the guy goes to Washington and shows all this fraud and waste. And what do? They run around and start keying Teslas and throwing paint at Tesla dealerships because they don't like what he's doing. And that just shows how out of control things are. How can a chunk of the country be against getting rid of fraud and waste when we have a debt problem that is immense? I guess if you were the ultimate virtual signaler, you'd key your own Tesla, right? Just to prove how you felt. But the point is the debt prop, when Trump came in and Bessent kind of laid out his plan and they were working on Doge, I was hopeful that they'd be able to do enough and to get the psychology to change. But I was afraid they might be 5 years too late. In other words, we might have added on the marginal 5 or 8 or 10 trillion. That was too much. It's hard to think of that much money being marginal. But at some point, there's one last snowflake that hits the hill that causes the avalanche. That doesn't really work like that because they're triggered usually by some sort of motion. But nonetheless, uh, you have this looming huge bond market problem, debt problem that we have, and you've got all this headline risk, and you've got an economy that's maybe not as strong as you think, and inflation to the upside is the risk, but yet the stock market chugs along. Why is that? Well, it's because of the passive bid and the flows that have been reverse engineered to participate in that. And then the option speculation that goes on top of that, and the momentum investing that's all intertwined and all of that. So you've got a market that is dominated by people that are just voting every day. I vote higher, I vote higher. And what I mean by that is Warren Buffett's expression: in the short term, the market is a voting machine, i.e., it's just opinions and fundamentals don't really matter. Over time, it's a weighing machine where fundamentals matter. Well, the size of the passive bid, and by that I'm talking about retirement money, is so big as it's got its thumb on the scale every day. And to change that, you would need some combination of less employment growth or layoffs, or a skew in how people were setting up their plans, i.e., more withdrawals. And something has to affect that bid at a moment in time when there's enough negative news to get it to be swamped and have a break to the downside. That's kind of what happened this spring. The passive bid was there, but it wasn't there in the same kind of size necessarily for whatever reason. And then the bad news hit and all the trade turmoil. We had the nasty break in the market, and the NASDAQ futures were almost limit down that one day. So it's an incredibly poor environment to want to own stocks generically. I myself have the highest cash position I've ever had in the 40 plus years I've been managing money. I mean, when I was running my short fund, my cash position was higher because you collateralize your shorts with cash, or at least I did, T-bills. But in terms of having no real market exposure, this is the most cash that I've held. And it's just because I think the environment's too difficult. I think individual securities that have the right characteristics can do well. I think precious metals will do well, as they have. I mean, my biggest area of emphasis, so to speak, or the most exposure I've had has been precious metals for the last 25 years. Yeah, it worked quite well most of the time. There was a few years where it was poor, but it's been a good, because all of the problems lead to more inflation and currency debasement. And if the problems get even worse, that'll exacerbate that. In other words, a lot of people think this will end, that this period will end in hyperinflation. I've never held that view, but the same things you would own to protect yourself from inflation or currency debasement would also protect you from hyperinflation for the most part, i.e. precious metals. So I think it's prudent to have more cash. You have to have precious metals. And then I think you have to find securities, if you're going to own them, that have unique characteristics, that some reason you think they can grow through a sloppy economic environment for whatever reasons that are unique to that business, and that have some sort of pricing power or margin protection. You need that kind of thing that you think can just grind through whatever the environment is. And they're hard to find. I mean, paying 18, 20, 30 times earnings for some generic high tech stock is really silly. I mean, it works. It works every day. The voting machine is winning, but when the weighing machine gets around to operating, it won't work very well.
Yeah, I want to make sure everybody understands what you say, because you've talked a long time about the passive bid, and you mentioned briefly retirement dollars. What you're talking about there is sort of the constant, every 2 weeks, everybody's paycheck, 75% of Americans buy more and more into these indexed mutual funds in their 4Ks,
Yes.
their IRAs, and that just kind of lifts the market, right? Because there's a bid behind that. They're going to buy at market price.
Correct.
They're not
It is.
going, your 401k is not setting a maximum it's willing to buy Nvidia at. It's just
No.
buying it at whatever the market price is.
Yes. It makes two decisions. I have money, buy them. I need money, sell them. Nothing else matters. It's the single most important thing to understand about investing in the period from, call it 2012 till now. It just keeps taking market share. And now it's 50% plus or minus, and maybe with the hangers on mimicking strategies, it's a little more. But if you don't understand that's why 1 and 1 makes 5 when it comes to a lot of these stocks. I mean, you have a company like Apple that's selling 30 times earnings, hasn't really grown in a couple of years, and has all kinds of problems in front of them. The court case on the apps that they're in the process of losing, the $20 billion they get from Google they're in the process of losing, the fact that they're not set up right for whatever Trump thinks he wants, whatever that is. And the fact there's saturation in phones. Making a cell phone today is a little bit like making a TV set. Who gives a crap? So, but it still sells at 30 times earnings, and that's why. And so a lot of people don't know this, but if if you're in Vanguard or BlackRock or any of these passive funds, you own a bunch of Apple. Well, I mean, there's going to be a train wreck in Apple sometime in the next year, I would guess. Full disclosure, I'm short the stock.
Huh. It's good to know where your position is on that. It is one of the largest components of the S&P 500, right? Apple is sort of been dragging up the returns of the index for a while now.
Right. I mean, given the fundamentals, the valuation's a complete joke. Well, we could have that conversation about lots of stocks. And the reason that is the case, and the reason fundamentals don't matter very often, is because of the passive bid. And anyone that wants to know more about that, and everyone should, you just need to go on YouTube and Google Mike Green. He was the one that first opened my eyes to it about 5 or 6 years ago, but he's the one who's really done the research and knows more about it than virtually anyone.
Is there a way that that ever sort of reverses, right? Like what move would these investors who aren't even really paying attention to what their 401k contains, what move would they have to make that changes that dynamic?
Well, if less money was allocated to stocks and more money was allocated to bonds, or you had not only no employment growth, but employment growth reversed, and we had layoffs, and then you had it skew in the mix of maybe the older people in their retirement change their skew, more bond, less stocks. Anything that disrupts the flow in, whatever makes it smaller or if it ever turned negative, I mean, then stocks could trade anywhere on the downside, literally.
Yeah. And we do have a big demographic cliff coming with the baby boomers, right? I mean, there's more and more and more retiring every day.
Yeah.
In
I mean,
theory, they should be moving from 60-40 to 40-60.
yeah, but everyone's greedy, so they don't do it.
Exactly. Especially when bonds are, with the long bonds paying, 4 points. Like it's barely above inflation. If we have high inflation, like you say, bonds aren't particularly
Well, I mean,
attractive.
depends on what you call high inflation. I mean, 4 or 5% is pretty high inflation over time. It
Yeah,
doesn't need 7, 8,
extremely.
or 9, right? And then you have to remember that the CPI is a poor indicator of inflation between the substitution and hedonic adjustments. I believe it mostly understates inflation, but it also depends on your walk in life, right? If you have a lot of gray hair and your kid like me, and your kids are full grown, and you, whereas if you're a young person, when you got 3 kids in school or 2 kids in school, and you have to buy all those, inflation impacts different stratas of the economy or demographics, or however you want to say it, differently. The people with the least amount of money, I think, get hit the hardest. And that's why
Absolutely.
people say inflation is the cruelest tax.
Yeah, it is the most regressive of all the taxes
Right.
we have, right?
Exactly.
Nothing more so than
Exactly.
that.
But it's so ephemeral. It's a concept. It's like smoke. You can't catch it, right? And so, nobody look, the politicians that we have are so worthless. They can't even agree to cut bona fide waste. And they're not going to tackle a problem like inflation or the national debt. There's no instant gratification in there. There's no hue and cry. So they just keep kicking the can and kicking the can. And the Fed has aided and abetted that. And then one of these days, we're going to get to a moment in time where that can't happen, and then we have to deal with it. And it'll be the only thing that matters, and there won't be much you can do about it. And that's the way big problems usually get fixed. After the 2008 real estate bubble, where the financial system nearly melted down, um, we got Dodd-Frank, which was pretty much a joke, really, in terms of addressing the real issues. No one in Wall Street really got penalized. We didn't change the way the government didn't try to settle up the debts. That was a huge crisis. People were scared to death. And all the net of what we got out of it was Obamacare. We didn't fix any of the underlying problems. So I'm giving you that as an example of, there was a crisis that was really scary. It worked that printing and QE kind of got us past it. So there wasn't, the need to radically alter the path we're on wasn't palpable then. I mean, people were just trying to hope the financial system did dissolve. And so that's the kind of sweaty palm scared you need to get these idiots in Washington, D.C. I'm speaking of Congress now more so than the current administration, because they're actually, I mean, with Doge, they're trying to do something at least.
Yeah, well, and it's Congress that ultimately has the power of the purse, right? It's Congress that
Right.
decides what we really spend.
Yeah, and you can just see in the ad. So anyway, the point is, it's going to take a serious crisis. There's going to have to be a lot of pain, and in that period of pain, I don't think the stock market's going to go up.
No matter how
That,
much the passive bid, it's
that
just
might
the
be that
passive
might be
bid
two
can't
years.
fight it.
That might be 2 years from now. I don't think it's 5 years from now. I don't know when it's going to be or what's going to be the trigger, but it's out there. I mean, you can already see. I mean, the size of the debt and the deficit are a focal point now, and they're huge. Anyway, anyway, that's the big iceberg that we can see. What we can't see is what's underneath the iceberg. The other problems are going to be associated with this. But anyway,
Yeah. I mean, it sounds like you're saying you see the shadow of a black swan on the horizon. You just don't know what that black swan is yet, right? But like if it lands, we're going to see
I mean,
something.
I don't know. It's more like the problems are obvious. What's not obvious is what's going to be the thing that's the tripwire that triggers a bunch of events that make it, oh my God, now we got to deal with this today. We can't keep kicking the can. That part's ended. And it's not obvious what would be the trigger that would cause a series of events that would all of a sudden make it be a problem here and now.
Yeah, but it's the pile of straw under the one that breaks the camel's back that is certainly gotten big. What other sectors are most vulnerable here? What other sectors are probably most resilient?
Well, I think that's anything that's directly attached to the consumer is going to have trouble because I think net consumers are struggling. People with money aren't because the market's been kind to them. So I wouldn't, and I think healthcare has probably got plenty of opportunities, but it's probably got plenty of landmines lurking out there. I don't. I've sort of solved the problem by just carrying a lot of cash. And in other words, I don't. I'm not looking at this as okay. Well, how am I going to find the right sector to get me through here? Found a few individual companies that I think can do well. And if I don't think the individual company can do well, then I just don't care. I want to hold a bunch of cash. I'm willing to do that. And I'm willing to short stocks. I had a short only fund for 12 years till I shut it down when QE started. So I don't really think about it that way. I'm not trying to run a portfolio and decide, okay, I'm going to move here, move there. I mean, I have the luxury of doing it the way I want to. And I want to own, precious metals, mining-oriented companies, mining companies, and some of these small rifle shots. I think you have to have individual ideas that are going to work because this will work in a crummy economic environment because they'll be able to grow their units, they'll be able to hold their pricing. They will be able to do this because this, and this. If you can't articulate that to yourself, then you might have a problem as the environment gets more difficult.
Sounds like an environment that favors the stock picker, the actively managed portfolio over the passive.
No, I'm not saying that. I'm saying the indexing rules the day until it doesn't. Okay. I don't want to play that game. Stock picking has not been a particularly rewarding endeavor because active managers keep losing money. So there's less of them and the passive keeps getting more. I'm not saying that's about to change. I'm saying for me, and so if I find a really good individual company that I think is priced right, it's got all the right characteristics, in an environment, any environment pre, say, 2008, let's call it, other investors would find that and it would work in terms of the price going up sooner. Now things have to get that much better. It takes more, it's harder to have an individual idea that gets discovered if it's not something that's essentially a meme stock, which is, all speculation. So it's not a great environment for individual stock picking, I don't think. But I have no interest in playing the passive game. And individual stock picking works well enough if you get the right things, but it's quite difficult. The passive investment is going to dominate until it doesn't.
Got it. So it's like water at the levees. It's just going to keep pushing up against it until it finally breaks at some point.
Yeah. Yeah. And who knows when that is. And so, but the companies that I own, I could sleep at night with them. I know they may not work as well or as soon, may take more time for them to work out from a stock price standpoint than I would hope, but I can live with the investments.
An underappreciated aspect of money management, right? You do have to
Yeah.
be able to sleep at night and not have
Correct.
heartburn that your
Yeah.
portfolio is going to
Yeah.
melt down from some exigent circumstance.
Yeah. And not be totally stressed out. You got to be willing to understand things that might seem uncomfortable to you. A lot of times what people do is you start to tell them something they don't want to hear and they go like this. And then they
Yeah,
ruin
as you
the day.
said, that's been a very good strategy for 30 years,
And then
right?
they wind up ruining the day that they did that. So,
I think a lot of people felt that way in 2008, but that was followed up with a big bull market. Does that happen again, or was that unique to 2008?
well, that was, to me, that was essentially QE that did that.
Can they just paper over it again, or is that
No, I don't
the
think so.
equivalent?
Because if the Fed starts QE, I think the bond market backs up this time. Now, maybe they start QE in a big enough crisis, but by that time, stock prices would be down a whole bunch. So, I mean, we can walk through all kinds of permutations, but yeah, they may try QE again. That's why you got to own gold and things like that. I don't think they'll be successful in getting it to work as it has, but we'll see. A lot depends on how the events come together as to what works initially, and then will it work over time. And it depends on what's happening.
Absolutely. Circumstances rule the day. A lot of what Bill shared are potentially uncomfortable moments coming up for the market. Yet he's finding ways to deploy capital. He has a portfolio that helps him sleep well at night. If you're looking for help constructing a portfolio that does the same for you, consider going to worthnet.com and scheduling a free consultation with one of our partner investment advisors. They can help you build a personalized plan intended to help you both protect and grow wealth through this economy. Thank you, Bill. I really appreciate your insights on the market, sharing them with our viewers.